Morning. Good morning. It's great to see everybody. Welcome to the Tokenize This conference. We're going to kick off with a fun little panel. I'm Colin Cunningham. I lead tokenization at Chainlink. And you know what? Rather than talk about each one of you, just give a quick intro, and then we'll get right into it.
Hey guys, I'm Morgan Kropetsky. I lead institutional and capital markets business development at Avalabs. Avalabs is a software company building infrastructure and tooling to really drive forward the growth and adoption of the Avalanche blockchain.
Good morning, everyone. I'm Nick Dukoff. I'm head of institutional growth at the Solana Foundation.
Hi, everyone. I'm Rob Dursky. I lead the tokenization and regulated assets projects out of Stellar Development Foundation, and we're the foundation behind the Stellar blockchain. Nice to be here.
I'm Brad Chase. I'm Vice President of Engineering at Ripple. I lead our RippleX team, which is contributions to the open source XRP ledger.
Cool. All right, so we're talking blockchain activity and tokenized assets at today's panel. Just to maybe set the scene, right? When we talk about tokenization, what we're really talking about is how these traditional financial assets from the real world, how do they move on chain? How do we enable, bring utility to them? And then how do they flourish and kind of proliferate? The way I kind of think about it is that we've got these different layers, right? So we have these market participants at the top that want to participate. We have different service providers, right, along the way that kind of support those market participants. And then we have this really important infrastructure layer, right? And I think our panelists today will hopefully give us some insight into how we think about different blockchains, how they're used, how they collaborate, how they work together to build a tokenized asset or a real-world asset economy on chain that hopefully provides some benefits from the way the world is structured today around traditional financial instruments. But let's start here. This isn't the first time we've talked about tokenization. We've talked about it for many years now, right? Some of you have been at some of these shops for quite some time. Morgan, let's start with you. Just help us think about historically this time. Why is it different? Is it different? If it's different, why is it different? Just give us some insight into where we've been, and then I'd love to hear from some of the other panelists, right? How this time feels relative to other tokenization start and stops in the past.
Sure. So I think, like you said, tokenization is not a new concept. It's been around for a while. It kind of reemerged as a trend over the past 2 years, I'd say. I think at a high level, quote unquote, this time is different for a few reasons. I think this time around you have much more kind of institutional and enterprise grade infrastructure in place. There's definitely still like areas that we need to improve upon, but at a high level, it's definitely kind of greater. In addition, I would say we saw from a macroeconomic perspective rates in the real world going up, and therefore the value prop for pure on-chain DeFi based on like self-referential tokens going down. And so you saw a lot of kind of cash flowing out from on-chain to off-chain. And so it really kind of presented a need to bring real yield or real world assets on chain, which is a lot of the reason why we're seeing a lot of kind of tokenized T-bills, which I'm sure we'll talk about. In addition, I'd say the advent of DeFi this time around versus last time was not a thing. And so the advent of DeFi, I think, really demonstrated that there is greater utility and capabilities that could be applied to tokenized assets beyond just issuance, trading, and settling, right? There's greater utility as it relates to potentially pledging as collateral and the composability and all the stuff that DeFi kind of brings with it. And then the last big thing that I would say is this time around, you're seeing major, Wall Street firm executives touting the future as tokenization and not just talking about it, but actually doing stuff in the space in production. And so I think between all those factors, they've kind of really come together to, push this space forward and, looking forward to kind of what's next.
I have a quick thought about that. I think on top of what was raised here, we reached a stage where regulations and traditional financial institutions are in a much more comfortable position to start building stuff. And I don't think we're at all where we want to be, but much better than we were before. So I will take this much more of an opportunity to say, wherever we reach that stage, we need to expand that to other geographies, incentivizing regulators and traditional financial institutions. But I think the answer to the question is, why is it different now than it was in 2016, 17, when all the top consulting firms were saying tokenize is the future, insurance, banks, whatever, and nothing happened, was because there was a complete lack of regulatory guidance, and traditional financial institutions like, I'm not touching that at all, where now they're experimenting, building with some regulatory comfort. But I think that's what we need to push for, is more regulatory clarity. Therefore, financial institutions will adopt more, will try more. And to Morgan's point, I think the, let's say, AAA infrastructure providers being out there to help those traditional institutions to build. But honestly, I think if the regulation is clear, they will either build it themselves or use trusted partners. But that, I think, what really changes this moment versus 5 years ago.
Yeah, I'll pile on a little bit. So just couch that in Ripple's experience. So Ripple's been around for over a decade. I've been at Ripple for almost 8 years now. Very much true. Like we've seen this story play out a couple times. And for me, what's different is very similar to what Rob said. Like really 10 years ago, Ripple's original strategy was to go to banks to get them to issue fiat-backed. We called them IUs at the time. You call them stable coins today. And everyone said, no, we're not touching this yet. We don't know what this is. And so I think in addition to the regulatory aspect, there's also this track record of resiliency. This technology's been around for 10 years plus years. We've seen Bitcoin go through these cycles, Ethereum, XRP, all these chains. Like, I think there's a confidence there that is enabling institutions to lean in, that coupled with the macroeconomic conditions, coupled with regulatory clarity, coupled with better infrastructure, I think it is, like all these ingredients are kind of that activation energy that we're kind of hitting now, where you're seeing real world use cases emerging.
Credit confusion. We've all been there. It's a common scenario that many of us face at some point in our lives. You get your credit report, and it's filled with numbers, terms, and red marks that seem to make no sense. It's like trying to read a foreign language without a dictionary. Let's be honest, folks. Credit scores can feel like a mysterious puzzle. You might be wondering, what do all these numbers mean? Or how did my score drop even though I paid my bills on time? It's a puzzle that can leave you feeling frustrated and helpless. You try to play by the rules, pay your bills on time, and yet your credit score seems stuck in a rut. It's frustrating, right? You might even start to question if there's something you're missing or if the system is just rigged against you. The truth is, maintaining a good credit score involves more than just paying bills on time. We've all been there, staring at that credit report, wondering how to crack the code. You might spend hours highlighting sections, researching terms, and trying to figure out what went wrong. It's a daunting task that can leave you feeling overwhelmed and defeated. But what if I told you there's a secret weapon out there, something that can help you understand and improve your credit score? It's not magic, but it can feel like it when you see the results. This secret weapon can demystify the credit score puzzle and put you back in control, a way to boost your credit score and unlock a world of financial opportunities. Imagine being able to qualify for better interest rates, get approved for loans, and even secure that dream home. It all starts with understanding and utilizing this powerful tool. Get ready to dive into the world of UCC filings, your ticket to credit success. UCC filings, or Uniform Commercial Code filings, are a set of laws that govern commercial transactions in the United States. They can play a crucial role in improving your credit score by providing a clear record of your financial obligations and assets. We're going to break down this powerful tool step by step, so you can take control of your financial future. We'll explain what UCC filings are, how they work, and how you can use them to your advantage. By the end of this journey, you'll have the knowledge and confidence to navigate the credit landscape with ease. It's time to ditch the credit confusion and embrace a brighter financial future. Let's get started. Together, we'll unlock the secrets of UCC filings and set you on the path to credit success. So grab a pen and paper, take some notes, and get ready to transform your financial life. The journey to a better credit score starts now. UCC filings sounds intimidating, right? You might be thinking, what on earth is a UCC filing, and why should I care about it? Well, you're not alone. Many people feel overwhelmed when they first hear about UCC filings, like something only high-powered lawyers deal with. It conjures up images of complex legal jargon and endless paperwork, something that seems out of reach for the average business person. But hold on, because UCC filings are not as complicated as they sound. In reality, they are quite straightforward and can be incredibly beneficial for your business. In fact, they can be your secret weapon to building rock-solid credit. Imagine having a tool at your disposal that can significantly enhance your creditworthiness and open up new financial opportunities. UCC stands for Uniform Commercial Code, but you don't need to memorize that. What's more important is understanding how it works and how it can benefit you. What you do need to know is that UCC filings are legal documents that create a public record of a business transaction. This public record is crucial because it provides transparency and security in business dealings. Think of it like this. When you borrow money from a bank, they file a UCC filing to secure their interest in your loan. This means that the bank has a legal claim to your assets if you default on the loan. This filing becomes part of your credit history. It's like a footprint that shows your financial activities and responsibilities. Now here's where it gets interesting. You can use UCC filings strategically to build your own credit history. By understanding how to leverage these filings, you can create a strong financial foundation for your business. By creating trade lines through UCC filings, you establish a track record of responsible borrowing and repayment. This track record is invaluable when it comes to securing future loans and investments. So how do you go about creating these trade lines? It starts with understanding the types of transactions that can be recorded through UCC filings. These can include loans, leases, and other financial agreements. Once you have a clear understanding of the transactions that qualify, you can begin to strategically plan your financial activities. This involves working closely with your financial advisor or legal counsel to ensure that each transaction is properly documented and filed. Proper documentation is key. Each UCC filing must be accurate and complete to be effective. This means paying attention to details and ensuring that all necessary information is included. Timeliness is also important. UCC filings should be made promptly to ensure that your financial activities are recorded in a timely manner. This helps to build a consistent and reliable credit history. Over time, as you continue to engage in responsible financial activities and make timely UCC filings, you will see your credit history strengthen. This opens up new opportunities for growth and expansion. Investors and lenders will see your strong credit history and be more willing to provide funding. This can be a game changer for your business, allowing you to take on new projects and reach new heights. So don't be intimidated by UCC filings. Embrace them as a powerful tool in your financial toolkit. With the right strategy and understanding, they can be your secret weapon to credit success. Remember, building a strong credit history takes time and effort, but with UCC filings, you have a clear path to achieving your financial goals. Start today and unlock the potential of your business. Your secret weapon to credit success is within reach. Use it wisely and watch your business thrive. Why should you care about UCC filings? Because they can be your golden ticket to accessing better loans, lower interest rates, and even higher credit limits. Here's the deal. Business credit is a whole different ball game than personal credit. And guess what? UCC filings are the name of the game in the business credit world. When you have positive UCC filings associated with your business, lenders sit up and take notice. It shows them you're serious about managing your finances and repaying your debts. Think of it like building a reputation. The more positive UCC filings you have, the stronger your business credit reputation becomes. And a strong business credit reputation can open doors to a world of financial opportunities. Section 4, building trade lines, laying the foundation for credit growth. Now let's talk about trade lines. No, we're not talking about those lines you stand in at the grocery store. In the credit world, a trade line is simply an account that reports to a credit bureau. It could be a credit card, a loan, or even a utility bill. The more positive trade lines you have, the better your credit score. But here's the catch. It can be tough to qualify for new trade lines if you're just starting out or if you have less than perfect credit. That's where UCC filings come in. By leveraging UCC filings, you can create your own trade lines and start building a positive credit history from the ground up. Section 5, Taking Action, a step-by-step guide to filing UCC1 forms. Ready to roll up your sleeves and start building your credit with UCC filings? Great. This guide will walk you through each step, ensuring you understand the process and can confidently take action. Building business credit is a crucial aspect of growing your enterprise, and UCC1 filings are a powerful tool in this journey. Let's break down the process into manageable steps. By understanding each phase, you'll be better prepared to navigate the complexities and ensure a smooth filing experience. Whether you're a seasoned entrepreneur or just starting, these steps will provide clarity and direction. Step 1, choose your partner. This is a critical decision. You'll need to find a company willing to extend credit to you and file a UCC1 form. This company will act as your secured party, and their willingness to extend credit is a vote of confidence in your business. You'll need to find a company willing to extend credit to you and file a UCC1 form. This might be a supplier, lender, or another business entity. It's essential to establish a good relationship with this partner, as their support will be instrumental in your credit building journey. Don't worry, there are companies that specialize in helping people build business credit through UCC filings. These companies can guide you through the process, offer advice, and ensure that all necessary steps are completed accurately. Their expertise can be invaluable, especially if you're new to UCC filings. Step 2, complete the paperwork. This step involves gathering and filling out several important documents. You'll need to fill out some paperwork, including a security agreement and a UCC1 financing statement. The security agreement outlines the terms of the credit arrangement, while the UCC1 financing statement is the document that gets filed with the state. You'll need to fill out some paperwork, including a security agreement and a UCC1 financing statement. Ensure that all information is accurate and complete, as errors can delay the filing process. It's often helpful to have a legal or financial advisor review these documents to ensure everything is in order. Step 3, file the UCC1 form. Once the paperwork is complete, you'll file the UCC1 form with the appropriate state agency, usually the Secretary of State. This filing makes the security interest public record, which is a crucial step in establishing your business credit. Once the paperwork is complete, you'll file the UCC1 form with the appropriate state agency, usually the Secretary of State. This step can often be completed online, but it's important to follow the specific instructions provided by your state to ensure the filing is accepted. Step 4, make payments on time. This part is crucial. Timely payments are the backbone of building a positive credit history. Make sure you make your payments on time every time to build a positive payment history. Setting up automatic payments or reminders can help ensure you never miss a due date. Make sure you make your payments on time every time to build a positive payment history. Consistent, timely payments demonstrate reliability and financial responsibility, which are key factors in building strong business credit. Remember, consistency is key when it comes to building credit. Keeping detailed records of your payments and maintaining a steady payment schedule will help you build a solid credit profile over time. Regularly review your credit reports to ensure all information is accurate and up to date. By following these steps and making timely payments, you'll be well on your way to a brighter credit future. Building business credit takes time and effort, but the rewards are well worth it. A strong credit profile can open doors to new opportunities, better financing options, and greater business growth. Stay committed, stay consistent, and watch your business credit flourish.
The last thing I'd add is I think the on-chain economy has grown with the technology, so has now the dollars. I think 5-6 years ago, a lot of folks were holding tokens in centralized exchanges or self-custody and not doing a lot with those tokens. Now those tokens are being used in the economies on the various blockchains. So for example, Solana had $1.5 trillion of stablecoin value transfer last month in March. And when you see those types of numbers, it kind of forces large enterprises to think about how to engage with those economies.
So let's go to this idea of production, right? We're getting more regulatory clarity, right? We're seeing new use cases. We're seeing utility unlocked. I'm sure we'd all love to know what you all have in the pipeline within your various ecosystems, but let's kind of talk about what's in production, right? What's live? What can we talk about from a use case perspective for partners within your ecosystem? And Rob, maybe we'll start with you here, is talk to us a little bit, if this time is a little different because there's more clarity, right? What's the utility? What are the use cases that people are looking to Stellar or any of the chains here as they think about tokenized assets on-chain?
No, happy to. And again, I think we're really together in this here in different chains, but very similar use cases. And I think ultimately that the goal is to try to get more financial institutions to try distributed ledger in general, right? Speaking a bit about the data and the information I have from the Stellar ecosystem, I try to simplify how we kind of bucket the tokenization use cases in payment assets and investment assets, right? So we're seeing both of them growing, and then they can be broken down into many types of assets, but both use cases are growing fast, and now more the investment side, because stable coins and others have been around for a while. But I think it's the interoperability between those two that really is going to unlock the value. So what we're seeing now with partners like Franklin Templeton, Wisdom3, and others that are issuing this kind of new round of assets on chain is that they want to unlock yield, they want to unlock easy investment products and easy access to retail clients, but they also want to make it almost kind of seamless to use that as a payment tool as well. So either you're coming from USDC or other stable coins because you're on DeFi and now you want to go back to a more regulated, lower risk asset, but you also can actually use those tokenized assets as payment. So nothing prevents us here to kind of splitting the check on a dinner, and I pay you guys with Franklin Templeton funds, because I can send you $20 in 3.6 seconds on Stellar, and there you go. I paid you dinner. If you forget about that, you're getting 5-6% a year on that bill that we split. So I think there's this, positive blur between investment and payment, because it's ultimately value, right? And we're unlocking the movement of value. So I know this is very philosophical, but in practical terms, that's what we're seeing happening. It's like retail wallets unlocking the usage of payments and investments almost as the same seamless experience.
I would maybe just add to that. So I totally agree, and I think what you're kind of alluding to is really from a underlying blockchain protocol perspective is really the idea of using and leveraging a shared distributed ledger as a means of value transfer, right, across whether it's payments, investments, whatever it is, where historically you have in TradFi, many different third parties and systems operating in silos and therefore requiring a lot of manual reconciliation, which obviously adds to a lot of the costs that leveraging this kind of shared distributed ledger for data and value transfer, obviously makes it a lot easier and more efficient and ultimately cheaper. In terms of what we're seeing, I think it's probably along the same lines where anecdotally, I'd say a lot of the interest from a financial services perspective is really kind of in two ends of the liquidity spectrum. On the one end, we're seeing a lot of interest in the tokenization of cash and cash equivalents, so stable coins, tokenized deposits, wholesale CBDCs, yield-bearing stable coins, and money market funds. And to that end, a lot of the issuers, whether they're kind of large asset managers or more crypto-native startups, I think, to your point, Nick, are targeting the more kind of crypto-native audience. They're looking at kind of all of the USDC and USDT that's on chain that's not bearing any yield. So I think the go-to-market is very much focused on kind of converting some of that crypto-native holding from treasuries and DAOs to potentially yield-bearing low-risk assets. And then on the other end, seeing a lot of interest in, I would say, the tokenization of alternative assets, so private equity, credit, real estate, and infrastructure. And the motivation, I think, there is, in the first instance, less so targeting crypto natives and more targeting kind of the growing mass affluent and accredited investor market in the US and globally, where historically they've just not had systematic access to these types of investments. So the idea is, you combine not just tokenization, but smart contracts and blockchain to really create the efficiencies and cost savings in the administrative process to make lower investment minimums economically viable for issuers, and therefore allowing these individuals to have more ready access to these types of investments. So I'd say at a high level, those are kind of what we're seeing.
A good credit score is like a golden ticket in the financial world, opening up numerous opportunities. It opens doors to better loan terms, lower interest rates, and more favorable financial products. You'll receive better credit card offers with higher limits and more rewards. Think of it as your financial report card, reflecting your financial health. Lenders use it to assess your creditworthiness and decide if you're a good risk. A high score shows you're responsible with money, paying bills on time, and managing debt well. A good credit score can save you thousands of dollars over your lifetime by reducing interest costs. You'll qualify for lower interest rates on mortgages, car loans, and credit cards, making big purchases more affordable. This means more money in your pocket, which you can save or invest. A good credit score also gives you negotiating power when dealing with lenders. You can shop around for the best rates and terms, ensuring you get the best deal possible. Building a good credit score takes time and effort, but the rewards are worth it. It's one of the most important things you can do for your financial future, setting a strong foundation. With a little planning and discipline, you can achieve your financial goals and dreams. Remember, a good credit score is an investment in yourself and your future, paving the way for financial success. Want to boost your credit score? Consider UCC Filings. They might sound intimidating, but they're a powerful tool for building credit. UCC stands for Uniform Commercial Code. These filings are used in secured transactions. Here's how it works. You use an asset, like a car or savings account, as collateral for a loan. This loan is then reported to credit bureaus. UCC filings show lenders you're serious about repaying your debts. It demonstrates financial responsibility. UCC filings can be especially helpful for people with limited credit history. They provide a way to establish creditworthiness, but even those with established credit can benefit. UCC filings can diversify your credit mix and improve your credit utilization ratio.
Before diving into UCC filings, it's crucial to have a solid financial foundation. Start by examining your finances. Review your credit report and identify any areas for improvement. Pay down outstanding debts and make timely payments on all your bills. Next, focus on building a positive payment history. This is the most crucial factor influencing your credit score. Make sure to pay all your bills on time, including utilities, rent, and credit card bills. Consider using a secured credit card if you have limited credit history. These cards require a security deposit, which serves as collateral. This helps you build credit safely and responsibly. Remember, consistency is key when building a solid financial foundation.
Ready to take control of your credit and secure your financial future? Here's a comprehensive step-by-step guide to using UCC filings effectively. Before you begin, make sure to review your credit reports from all three major credit bureaus, Equifax, Experian, and TransUnion. Identify any negative marks on your reports and work diligently towards resolving them. Next, determine which of your assets you can comfortably use as collateral for the loan.
Consider establishing a trust structure, such as the basic 3-trust model, to manage your assets. This helps protect your assets and adds an extra layer of privacy and security. Consult with a legal professional to determine the best trust structure for your specific needs.
This form registers your interest in the collateral used for the loan, making it official. Gather all necessary documentation, including your trust agreement and loan agreement, to ensure everything is in order. Complete the form accurately and file it with the appropriate Secretary of State office in your jurisdiction. Once the UCC one is filed, establish a payment plan that aligns with your budget and financial goals. Ensure timely payments to avoid any negative impacts on your credit and maintain a good standing. Monitor your accounts regularly to track progress and make adjustments as needed.
Regularly review your credit reports and check for accuracy to ensure there are no discrepancies. Update your UCC filings as needed, especially if there are changes to your collateral or loan terms, to keep everything current.
Section 5. Reaping the rewards. Better credit, better life. Implementing UCC filings strategically can lead to a significant boost in your credit score, which is a crucial aspect of financial health. A higher score opens doors to numerous benefits, including enhanced credit profile. It can make a big difference in your financial opportunities. UCC filings diversify your credit mix and demonstrate responsible financial behavior to lenders, showcasing your financial maturity. Negotiating power. A strong credit score gives you leverage when negotiating loan terms, helping you secure lower interest rates and better deals, which can save you money in the long run. Asset protection. The trust structure used in UCC filings can provide a layer of protection for your assets in case of unforeseen circumstances, ensuring your financial stability. Remember, building good credit takes time and effort, but it is a journey worth embarking on. But the rewards are well worth it, offering peace of mind and financial freedom. By utilizing UCC filings strategically and adopting responsible financial habits, you can pave the way for a brighter financial future, filled with opportunities and security.
Section 6. A word of caution. Proceed with prudence. While UCC filings can be a powerful tool, it's crucial to proceed with caution. Don't rush into anything without fully understanding the process and potential risks. Here are a few things to keep in mind. Consult with a financial advisor or credit counselor to determine if UCC filings are right for your situation. Thoroughly review all loan agreements and UCC filing documents before signing. Ensure you understand the terms and conditions. Only borrow what you can comfortably repay. Avoid using UCC filings as a way to accumulate excessive debt. Remember, UCC filings are not a quick fix. They are a strategic tool to be used responsibly and with careful consideration. Section 7. The importance of professional guidance. Navigating the world of UCC filings can feel overwhelming, especially if you're unfamiliar with legal and financial jargon. Seeking professional guidance is crucial for ensuring a smooth and successful experience.
A qualified financial advisor can assess your financial situation, goals, and risk tolerance. They can provide personalized recommendations on whether UCC filings align with your overall financial strategy. Attorneys specializing in business and financial law can guide you through the intricacies of establishing trusts and filing UCC documents. They ensure compliance with legal requirements and protect your interests.
Remember, seeking professional guidance is not a sign of weakness. It shows you're serious about taking control of your finances and making informed decisions.
Section 8. Your journey to financial freedom. Improving your credit score is a journey, not a sprint. It requires patience, discipline, and a commitment to responsible financial behavior. UCC filings can be a valuable tool on this journey, but they're just one piece of the puzzle. Embrace the power of knowledge. Educate yourself about credit, personal finance, and the impact of financial decisions. The more you know, the better equipped you'll be to make sound choices. Develop a solid financial plan that outlines your goals, income, expenses, and debt management strategies. Review and adjust your plan periodically to reflect changes in your life and circumstances. Section 9. Take control of your financial future. Remember, you are in the driver's seat of your financial future. UCC filings are just one tool at your disposal. By taking a proactive approach, educating yourself, and seeking professional guidance, you can pave the way for a brighter and more secure financial future. Don't let fear or uncertainty hold you back. Embrace the power of knowledge. Take control of your credit and start building the financial future you deserve. Your future self will thank you.
I agree with what both of my colleagues here said, and the thing I would add to what Morgan said is on those longer duration assets, the private fund tokenization, it's also adding liquidity and utility to those. So today, if I'm an investor in a private fund, there's virtually nothing I can do with that. My name is on the cap table, and for 7 to 10 years, I just sit and wait until that comes back. On chain, with secondary markets, which don't really yet exist today for these assets, but will tomorrow, I think that provides liquidity and then utility. In the meantime, while I have that token, I can pledge it as collateral and borrow against it to use it for other needs that I may have today.
Mostly +1, not a lot of disagreement on this. I guess the angle I could share just from Ripple's enterprise software offerings and kind of how we're seeing tokenization trends from our customers. So one, our biggest offering is a cross-border payments product called Ripple Payments. Shared DNA with Stellar in many ways. So, also, can send funds and settle globally in 3 seconds. Those customers now have their own customers that want to pay in stable coins, and they want to hold those stable coins. So that's kind of the simplest on and off ramp gateway for them into the space. And then last year we acquired a company now offer a custody product. HSBC is a customer, and they're now looking to tokenize. They see the benefits that their customers are getting from holding digital assets, like purely native digital assets on their behalf, and now what else can we kind of use this technology for? So the same kind of trends that we're all seeing here, where they're seeing the benefits and wanting to lean into the space.
So one of the things I think a lot about when it comes to blockchains is there's probably like some standalone benefits of the blockchain itself, right? And then there's these ideas of interoperability and composability, which I want to punt on for just one more question. Let's come back to just blockchains purely. We just talked about some good use cases on how the partners think about it, right? Blurring the line on payments, fractionalization to some degree, or kind of like knocking down the minimums for which investors can access traditional assets, and some of the collateral, utility or leverage ideas, right? When we think about just blockchains at a pure technical level, bit of a targeted question, but what's like for you at an individual level, or if you want to talk your company's book, that's fine too. What's like the specific thing that you think blockchains specifically like make the greatest gains if you just look at a blockchain as a standalone entity, right? On behalf of some kind of traditional, let's take it from more of the institutional angle, from more of the institutional set, right? Or more of the traditional TradFi set. What's the thing that the blockchain is really positioned technically to solve the best?
I think it's atomic settlement, right? To be able to have access to the cash once you trade out of a token and then be able to redeploy that immediately elsewhere. And the fungibility, right? To use it as payment or whatever else you want to use it for. So I'd say the fungibility and the settlement.
Any disagreements with that? Any other ideas around that?
Well, I don't think it's a disagreement. It's just on top of that. So I think that's very important. I think for those who comes from banking, the idea of the messaging layer and the settlement layer being completely decoupled has been around for decades, right? When we think about SWIFT and then doing correspondent banking next day or next week settlement, that is something that in general doesn't need to exist on blockchain because you're literally submitting a fraction of a cent or a billion transaction in real time and the settlement is done at the same time. But on top of that, I would say that especially for smaller companies, and we try to help those a lot, is the fact that you don't need to necessarily sort out your own core banking ledger infrastructure versus using a shared one. So that could, put you up to speed faster on a new product or a new project. And maybe broadening that concept to bigger entities. The analogy that sometimes I use is that each central bank has been building their own highway for decades on trying to create infrastructure for their country, and blockchain kind of in parallel create a international highway. People could argue if the cars have the right plate or if they're in the right speed, but that said, if you share that ledger, we're literally being able to send stuff between entities with no additional hurdle, right? Like nothing prevents Bank A to send assets to Bank B if they're on blockchain. So I would say it's this kind of go-to-market opportunity for smaller entities, and the fact that you're sharing the same ledger as you're potentially joining the same chain or with interoperability layers that I know we're going to get there.
One thing I just add, that I guess kind of the technology that enables those things to me is just the shared immutable state that a blockchain affords, where it enables us to be somewhat public infrastructure that we all share, and that lowers the barriers to entry, lowers cost to operation, and just gets these efficiencies of atomic settlement and beyond. So I'd say, like, from a technical innovation, if you take away the use cases, it's really that shared immutable state that you can reach in a decentralized manner is just, blockchain and Bitcoin, as the original was the game changer.
You really want us to disagree, don't you?
Just trying to get it cooking in here. So let's move then into kind of the interoperability or composability piece, right? Because I think that is fundamental to how we look at how this ecosystem builds, right? And in your own right, each of these blockchains have built their own ecosystems. You've built your own kind of digital economies, right, around your own blockchains, your own businesses. One thing that's popping into my head right now is maybe the difference between interoperability versus composability. And I think that might actually be an interesting, I could actually learn a little bit here, like how we differentiate those two. I think it'd be interesting to talk about that. But when we look at interoperability and we look at maybe the success or the moment that tokenization has right now, let's just talk about for a second, how important is interoperability to, if this is tokenization, this moment, if this moment is different, right? How important is interoperability, and what does that mean? Let's put that in context for the audience, for whoever wants to start.
So I'll jump in. The analogy, if you think about the internet, in the 90s you had AOL, you had CompuServe, you had Prodigy, you had probably other ones I don't even know of, and they were nice. You were able to do new things and use, access stuff with your computer, but you couldn't send an email to each other necessarily. You couldn't, foster information sharing, and you end up just having a walled garden that happened to be nicer, and there were more fun things to do in your garden. But I think, what the internet did is it took those walls down, and you started to be able to still have, pockets of specialization in places you would go to do things, but you could kind of transfer data across, you could interact, you can kind of have a portal that gave you that access. And so the same thing where there may be chains that are better for tokenizing or managing different real-world assets differently because they have different features from either security, core protocol capabilities, smart contract features, whatnot. That will continue, and that's how you innovate, right? You have specialization. But interoperability is what's the thing that's going to enable mass adoption, where I don't need to go get a new wallet for this other token, or I have to go to a different country to be able to use these things. And that's what the industry has been able to develop over the past decade. Obviously, there's lots more to do. So when I think of interoperability, it's that type of experience where it's you're in the system and you have the fluidity to move value and transfer value within it kind of efficiently.
Maybe just to add to that, I think when the industry refers to interoperability, just to kind of distill what we're talking about, it's the idea of being able to kind of seamlessly go from network to network, from layer 1 to layer 1, or layer 2 to layer 1, or...
Is that on-chain only when we talk about interoperability?
No, and I think to your point, it's kind of integration with traditional systems or traditional rails as well. And I totally agree with what you were saying, but I also think that to a certain sense, and maybe to be a little bit spicy, I think a lot of people are looking at interoperability today as the thing that will solve for mass adoption, whereas I think, instead a lot of kind of companies should instead be focusing on their application and their use case of what are they going to be building to enable and kind of draw the next X amount of users, frankly, without even knowing or caring that they're leveraging blockchain, and then kind of exploring what can interoperability kind of afford for user and user experience. So it's not interoperability just in and of itself, but it's what are the applications and use cases that we can build on chain today that are very compelling, and then kind of exploring what can the interoperability enable from there.
So maybe a word that describes what Morgan is talking about is abstraction. And that's one of the things that I think in the Solana ecosystem folks do particularly well is UX and making the blockchain very easy to use, and whether that be for retail or institutional. And that's from the infrastructure layer all the way up to the application layer.
Now. Okay, hopefully you guys can hear me. Hopefully you are following the content. So much to do, so little time. Got a big day planned for those of you that are here to find out how exactly to report credit is everything you're listening to. The ability to leverage the unified ledger is one of the easiest ways for one to go from zero to a hero. Now, I'm going to give you the highlights. You're going to need a notary to do this. I'm not going to recommend, prefer, or talk to anyone about the implementation of this unless you are a notary. So know that all of these things that you're learning about, you're going to need to have a qualified notary experienced in notarial law. Once you have that notary, then reporting credit is easy. Let me explain. I'm about to share with you my screen, and I'm going to walk you through a scenario, and hopefully if you listen long enough, not only will you learn something, you'll definitely kind of get it. All right. I'm going to go to a UCC ledger here. Let's see if I can find one. All right. This is a UCC financing statement. Now, this is the form that you're going to use to report credit. See, it has the debtor's information. It has the secured party creditor's information. This one here is kind of filled out with one that I use in another class talking about tokens, but you can still follow along to get the gist of it. Right here in section 4 is where it has the financing statement details, what we call the collateral line, section 4. And basically it says this financing statement covers the following collateral. And this is where you would spell out the do's and the don'ts for whatever it is you're trying to do, deal with, etc. That'll go in this section. Okay? Now, pay attention because this is where a lot of individuals fall off the wagon. Usually in Section 5, they will designate what they call alternative designations. You have leasee, leaseor. So that's if we're actually doing some sort of lease to a leaseor. That'll be that type of scenario. You got consignee, consignor. So you got the consignee, the person who's applying for a particular loan, and then you got a consignor who's also in that. You can check that. Then you got Bailey, Baylor, and if you don't understand Baylor or Bailey, then please do your research. Those of you that have been studying UCCs know what a Bailey, Baylor scenario is. Now pay attention to ag lien. Now, this is where not only reporting credit gets really interesting, but this is where it really rocks. Inside of our underwriting software, we have a parameter that allows us to collateralize collateral. And so it'll look for this box, agricultural lien, to be checked. And then whatever the collateral is inside of this collateral line is the collateral that's being collateralized. Then you have what they call a non-UCC filing. And then you have one for sellers and buyers. Okay. Now, if you are doing a loan, quote unquote, it could be a leasee, leaseor, cosigner, consignee, agricultural lien, seller, buyer. Let's just say for laughs and giggles, we're doing real estate, so it's a seller, buyer. Okay. Now, all that information, depending upon who's the debtor and who's the creditor, that information is filled out up here, and then the details about the collaterals in Section 4, and then any type of designation that you want to lay out. And these are alternative designations. You don't have to pick one of these. That's if it applies. You can use it in that capacity. Then, because we're talking about Florida, the Florida has Documentary Stamp Act, so if you're required to do it, then it'll tell you to check that one. If it's not required, check that. Then you have additional data. Line 7 is where I would kind of really go hard in the paint on all the details and information, especially if it's for credit reporting purposes. So line 4, line 5 if applicable, and line 7 is where you're going to spell out the relationship of the debtor, dettee, and if you're debtor, creditor, and if you're literally trying to report credit, you'll go hard in the paint on number 7. Now, this is the UCC 1. So this shows the creditor and debtor relationship. The next UCC, where the actual credit gets actually reported, because this right here creates a file, if that makes sense. The UCC 1 creates a file. The UCC 3, like, let's go here. If you need to actually make a change or an addition to the initial one, then you can do an addendum. That's a UCC 1 AD form, what we call an addendum. And again, you can add additional parties to it if you need to. That may apply, it may not. I'm just not trying to go through all of this, but I'm trying to give you the gist of how this works. You got the collateral line, all this stuff. Then you got also the amendment. So you can actually amend the UCC. So if you establish a UCC, then you amend. Now you're adding additional debtors and additional secured party creditors. You follow me? Like you got the current debtor, your current secured party, and now we're getting into, and this is the UCC. This is the money shot. This is the action. This is where credit gets reported. UCC 3s. Now this UCC 3 is going to ask you what was the UCC 1 number. So that's what goes right there, the UCC 1. And you're going to list all that information in this capacity, okay? So you're going to put the UCC control number, what was on the UCC 1, on the UCC 3. And you got either you can terminate this, continuation, assignment. You remember what we read about assignment, right? Then you got addendum. This assignment and addendum, like this assignment and the actual termination. When you terminate, that means the debtor paid the creditor. So if you want to report credit, you would have to have this UCC3, and you would check the termination, meaning that the debt existed, but it was paid off, therefore it was terminated. Once you put that in that capacity, and if you need to make any changes, addendums, you can. This is what the consumer reporting agencies look at to determine liens, levies, credit, this, that, and so forth. And if you have this UCC, first it has to be recorded with the notary inside of their journal. And then that journal is then used as a commercial registry. So this is the author. It's inside the notes and minutes of the notary. And then that notary takes that UCC and it does either termination on the record or continuation. Like if I wanted to show that this person's making positive credit, I would use a continuation. You follow me? I would show that they're doing X, Y, and Z and they're doing what they're supposed to be doing. Or if I got to reinstate a UCC, because they'll go stale after 3, sometimes 5 and 7 years, I'll hit a continuation to keep it going. And again, this UCC3 actually sets up the reporting. Now, once you have this file, they're going to give you a control number. Now, you as a notary will contact Equifax, TransUnion, and Experian, notaries will, and they would release for them to what? Update the credit file. Because when a notary does a notary presentment, an attestation, and jurat, that's a court proceeding. And usually within 24 to 74 hours, this information now becomes part of the credit report. Now, again, I'm leaving some parts out on purpose because I don't know who all is listening. We don't have, a way for me to tell on YouTube who's who. So I'm just going to basically say it like this. If you want more intuitive information, you want to directly get involved and get this type of reporting done, please get with the individuals that referred you to this information. You can reach our office at 561-873-2125. Again, remember, if you listen long enough, you definitely will learn something. And guess what? Tonight, for those of you that are MWR members, this information is just one of several parts. So we're going to say this is the foundation. The information I'm giving you right now is the foundation. But at 9 p.m. Eastern Standard Time, if you are an MWR member and you have already secured your spot in the inaugural debut of David Wren introducing ratio players to the ratio player parameter for all MVR members, then this is where you want to be. So let me just recap. A lot of folks are trying to figure out how do you report positive credit. You're going to put all of your pertinent information on a UCC1, and then when you want to report credit, like if you got rent history, if you got past credit cards, car payments, it doesn't matter what it is. You got to remember, though, the credit reporting agencies, they do Title 11 searches on the court records, and that's what goes on the credit file. So if you want to add credit, you need to get a notary, gather up your data, and file a UCC1 and a UCC3. The UCC3, when you want to report positive credit, you'll check the termination button. When you want to show positive payment history and they're still in good standings, you're going to check off the continuation button. If you want to assign credit to another institution or an individual, that's when you'll do an assignment. And if you want to add individuals, just like if you got a credit card and you want to actually add someone to it as an authorized user, you'll use the actual section that says amendment. This is where everything happens. Now, Mr. Bay, I know what you're saying. Well, if it's like that, why do all these credit reporting agencies make us do this, that, and the other? It's because public information is always looked at on court records. So these agencies are not going to make any money telling you to put all your information on a UCC. They want to put the information on a UCC. And again, I'm speaking to notary. So if you're not a notary, just don't pay attention to what I'm saying. I mean, pay attention to what I'm saying, but don't try this at home. You're going to need a qualified individual to do this. But this is where all the data goes. Hopefully this information was inspirational. It puts you in the right frame of mind. Look, I'm going to be here till about 7 p.m. If you need to get yourself together, get your credit files going, please make an appointment today. You can call the office at 561-873-2125. Remember, if you listen long enough, you definitely will learn something. Peace and love, family.